What's up? Come on in. We've got an afternoon stream. We're ready to rock here, baby. How we doing? Big bar 45, 245 out. Oh, you gotta love it. You gotta love it. We've got an ATR, a tremendous ATR of 25. Here on a 5-minute NQ chart. We can work with 25. It's not too bad. Only half sarcastic. 3/4 max. 85% absolute max sarcasm there. Okay, we've got wick low at 29. I'm keeping an eye on the wick low at 29 and 28. Here on bar 45, we'll see. We'll see what we get. Looks like we've got a big sideways range to me. The fact that it is so sideways leaves me a bit hesitant to take limit order reversion scalps because I know the probability of cracking the wick low of 28.29 is relatively high, and I would need to use that to manage my risk. So I'm watching here. I'm seeing if can 45 maybe give me a nice clean close well beneath 28 and 29. In that case, it's like, yeah, I could short it. I could short it. A little early for a stop hunt of the wick low at 13, of course. And by the way, you look at the wick low at 13, it's like, let me think. Put myself in the shoes of a bull for a second. If I was sitting long, would I use the wick low at 13 to manage risk? And I'd say, well, it's not as clear to me that I would as a traditional stop hunt might be. Like, for example, you come back here, you look at this. It's like, if you're sitting short, it's pretty clear that a lot of people are using the wick high of 4, right? That changes a little bit with 13, you know, in reference to now, where we sit currently. So we wait. We wait, and the second I get an opportunity, you know it's got to go on. But I am looking at this, and I'm thinking, yeah, man. Big sideways range. How we doing, by the way? You guys doing all right? Gamma Cold, what's up? How are we? Alex, good morning, big dog. Edge says, following the process, P&L looking good. Can't ask for much more than that. Chris, how we doing? How we doing? ATR sitting 25. You know, if I had to do anything right now, I'd have to get long and risk the wick low at 28, but I gotta tell you, I'm not the biggest fan. I'd probably rank that as at best, B minus. Just because I'm looking at bar, 28, I'm looking at bar 39, I'm looking at bar 43. So, ideally, if 46 could, well, I think ideally, if we could crack this low here and start heading lower, that'd be best case scenario, get a little bit of volatility back. But if we want to crank higher, I'm cool with it as well. I'd be more willing to get long, believe it or not, if we can show a little bit better close here out of 46. And then I'd probably go ahead and, rather than risking the wick low of 46 itself, I'd probably, if the bar stayed small, I'd probably use the wick low at 28. And treat it a little bit more like a regular trade, kind of let it take its time, rather than a super quick scalp. So anyway, that's the thought process right now. I'm just looking at this big range. But coming into the afternoon here, seeing the way those bears are putting up a fight and the bulls struggling to crank us back higher, I'd love to see a bearish, well, I guess to see the bulls kind of give way and let the bears take this guy lower. Nico, I think I lost your Discord server somehow. Can you send me a link to it? By the way, anybody, I should announce this. Anybody who's like, man, what happened? Did they ban me? No. No one banned you. Everybody lost access to it. The Discord server, I was looking at it yesterday and I'm like, why do we still have this? I think in 2026, Discord is played out. I think no one really cares anymore. So I saw a lot of you guys were using it for a while, and then, people kind of stopped hanging out together, and it really wasn't being used. So I'm like, streamline, the action is here and in the tomb. Got rid of it. Okay. Bar 46. 4.5 minutes out. Nico, are you from Germany? I am part German descent, but no, I am not from Germany. Okay, so 45, 46, making a press up toward the middle point of that range. Big sideways range. The range I'm looking at is this, roughly, okay? Get a bit of a pullback here. I can make sense of that. I'm going to use the wick low of 28. To manage my risk. Nico, how often did they get your name correct in school? Almost never. And that's okay. I don't blame them. So it's August 25th. We're coming into the end of August-ish. And we were taking bets a week ago, maybe, about, hey, you know, when's volatility going to return? I think I said I would love to see early September, if not late August. We still have some time here in late August. A lot of you guys said beginning of October, end of September at the earliest. Some of you guys, I think, said at the end of October. Which, I gotta tell you, man, I don't know if I can deal with another 2 months of afternoons that are this slow. You know, it's funny. I think a lot of people, they look at the market, and if you're a trader and the market's crashing, you know, they spend their day thinking about you. Like, oh man, they must not be doing so well. Don't worry about the day trader in your life when the market is crashing. In fact, they're probably rolling in it when the market is crashing. Same thing with on a huge bull push. You can check in on them on their mental health when the market's going sideways. If the market goes sideways for 2 years, you know they're probably not too happy. Luckily, we haven't had it go sideways that long, really, since I've been doing this for 9 or 10 years. But it certainly could. You got to keep that in mind. But I'll tell you what, I would rather be an active trader than be someone, you know how traditional long biased investors, you know, which all of us probably are, at least to some degree, as the longer term, you know, a part, I should say, of the longer term wealth play. When the market, like 2022 hits, all right, I'm flat, we'll watch bar 48. When 2022 hits and it's a huge bear market, like, there's not really a lot you can do if you're an investor. I'm not talking about swing trading. I'm talking about investing. You know, it's like you just wake up every morning, you check the portfolio. There's another 40 grand down the toilet. There's another 60 grand down the toilet. It's kind of a depressing existence to be subject to the market like that, which is why I think trading is, I mean, in a lot of ways, I prefer it. And a lot of people would say trading is a lot more risky than investing. I don't know. I mean, if the statistics are in your favor, I would much rather live the life of a profitable day trader than someone whose primary thing every day when they wake up and come into the office is to be an investor and buy stock. Because if you enter a bear market, there's not a whole lot you can do other than keep buying. And everyone says keep buying. Well, at some point, you're going to run out of capital. When does that happen? Hopefully, not before the bottom sets in, right? And not to mention, it's a little bit weird to be subject to another human being. Like if the CEO says something and the stock tanks 30%, you wake up, you're like, I didn't even do anything. So, I think being a day trader in a lot of ways is, for me, a preferable primary existence with the investing on the side. That way, when another bear market hits, which a lot of people seem to think is coming, I don't really care. I'll take it as it comes. I think being able to have a lot of opportunity as a day trader in a bear market, which is what a bear market presents for us, active traders, offsets the sort of stale existence of being an investor in a bear market. Because, if you're a day trader, you're an investor as a secondary thing because it's relatively simple. You bet on a few companies you really like and you hold for probably ever, right? But your primary objective each day is to show up and do your job as a trader. So in a bear market, I think you can still be in a really good mood because there's opportunity for your primary objective. That's the way that I look at this. Because I got to tell you, if you're just an investor, if that's all you are, there were a lot of depressed folks in 2022. There's good and bad with all of it, but being an active trader, I think, is a sort of a hedge against market conditions. Now, our Armageddon as active traders is if the market literally goes sideways and doesn't move for like 4 years, which can happen, by the way. But I seem to think with everything going on in the market lately and the market increasing in popularity the way it is, I imagine it's probably only going to get more and more volatile as the decades go on. That's sort of how it's always gone. So I would imagine the probability of that happening is only going to get lower as time goes on, which is really good for us because we need volatility. We really don't care which direction, as long as it moves and as long as the US stock market goes up over time, so the money we park in it also grows. So you see this bearish hesitation here. This is a very difficult time to go ahead and bet on a breakdown side. And now that we've taken out the wick low of like 44, 45, 28, 29, 23, this whole region here, 22 also, it gets even harder to manage risk for a bet back into the range. So this is one of those situations where it's a little bit awkward to make sense of a trade really in either direction. The probability downside just isn't quite good enough yet, and the reward to risk back upside is so good that the probability is also very low. Right? As you make a bigger and bigger reward to risk ask out of the market, naturally what happens to probability? It comes down. Okay, we got a minute 5 out here on bar 49. Coming on into big bar 50. We like big bar 50. Okay. There's bar 50. Now again, if you're looking at this range, it's starting to get closer and closer to, you know, actually trying a meaningful run at these wick lows back here. 19, 20, 15, eventually maybe 13. But, you know, you look at this right now, and it's like, well, if you wanted to bet on the range, you'd be hitting a buy order, limit buy, and you'd have to use the wick low 48. Now that's 12, 11, 12, 10 points away. Okay, the ATR is 22. It's even tight given the low ATR, which means that the probability of the trade working is lower. I think so many traders don't really internalize that. So is that a logical trade to take? Sure. But you're going to lose most of them. And that is okay. At least it can be if you're, well, if after the fact you look at all these trades you took and your win rate, or I should say your reward to risk, was enough to make up for that. Again, for some of you newer guys, you newer people out there, you can't think of this just as reward to risk or just as win rate. I don't know what it is. I feel like so many new traders, they like to just pick one of those because they saw a YouTube video that said 90% win rate. Or they saw a YouTube video that said 10-to-1 reward to risk. Both of those things sound really, really good. Both of those things also mean absolutely fucking nothing without the other. And the math of the market is such that if you have a setup that is profitable at 10-to-1 reward to risk, the win rate of it is not going to be that great because you're making a huge ask out of the market, right? And the edge that you can find in that trade is small enough. It's not, you know, it's not going to be ridiculously high for any trade, really. But the bigger that edge gets on a setup like that, guess what the third factor that everyone forgets is? Frequency. You might have a 10-to-1 reward to risk trade that you win 50% of the time. And you'd say, well, that's a ridiculous edge. I'm just going to take that all the time. The problem is opportunities like that, the better they get, the less often they occur. So you might be waiting 3 months for that setup. You take 3 or 4 trades a year, homeboy, I don't care how good your edge is. That frequency is too low. At least for my taste, it's too low. You know, I want a much higher sample size. So it's just a math equation. Pick what you're into. If you like to live on the extremes, you're like, I like to have a high win rate. So I'm going to go pretty heavily negative reward to risk. Have at it, man. Have at it. Just understand that most of those trades, you're going to win. But that one loser is going to be pretty large. How does that affect your psychology? And does the math still work when you know, the dust settles? Trevor says, well, what if you're going for 1R? In which example, Big Trev? I'm going to need a lot more information than that, man. Okay, the question here is, Nico, you were talking about if you were to get long here and risk the wick low 48 at the time, it's changing, but it would have been about 11 points. And saying that it wouldn't make sense to take the trade, I did not say that, given the low amount of points on the stop. No, that was not my reasoning. So, look, if you're going to take a trade, here, I have to draw. Look at this. If you were buying this and risking the wick low 48, what are you betting on? You're betting on this as a big range, effectively. Even if you take it off early, that's the bet, right? Okay, but risk is very tight. In my example, when I brought this up, it was like 11 points. Now it's like 5 points. Or 7 points, whatever. Okay, what does that do to probability? It tanks it. Now the question is, well, what if you were going for 1R? So if you're risking 7 points, what if you're targeting 7 points? For me, I wouldn't be so into that because the counter argument to this trade is that what if this turns into a soft bear channel? So the probability is even less what I would want it to be, even considering how close we are here. Okay, so for example, if you're risking 7 points to make 21, the probability of that trade is already naturally going to be lower because that's how the math of the market works, even if you have a small edge. Okay, so if I were going to take this trade right now, I would understand, okay, most of these trades I'm going to lose. Even, most likely, if I'm going for 1R, let's say. So what I would want to do is I would want to, okay, let's say I structure it where, all right, I'm risking 11 points. I know the counter argument is that we see a wedge or a soft bear channel, but we also have that big range, which is what I'm betting on. So if I end up targeting at least one ATR, which is 21, and my risk is 11, for me, I'd be interested. if I could keep the probability reasonable, which for me, I'm not really interested in risking less than like a half ATR. So if it's like 6 points away, NQ is just so volatile. That starts tanking the probability so low that to me, it doesn't even make sense to take it anymore because I don't like to live on the extremes like that. You know, where I'm going for a 15 to 1 reward to risk with a very low win rate. The same way that you won't really see me, I mean, maybe on a daily chart, if I'm thinking of it also like an investment, maybe you'd see me take a relatively low probability 10 to 1, 15 to 1 reward to risk trade, but I'd be holding it probably for weeks. Unless, you know, and that would mostly be on what a lot of people call the right side of the curl or the right side of the V, I've heard it referred to as. That's usually after a bear market or a crash in a stock, and then you get what I would call a RAM continuation setup on the right side, back upside, and then you get long and risk the low. It would depend how large the setup is on the right side, how much has it already recovered, you know, to what that reward to risk would be. But all that to say, I think a lot of you guys in the chat, what I just said probably sounds like it makes perfect sense to some of you, and to a lot of you it probably sounds incredibly confusing. The reason it sounds confusing is because, and this is probably too deep for YouTube, let me know if it is, I don't know. But I'm just going to tell you what it is and be unapologetic about it because I want you guys to win. So, the number one issue that I see on YouTube is that I think most traders think of this way too rigid. This is very fluid. You need to think of every trade the way that I think of every trade. Sorry, that sounds off. The way that I think of every trade, which you can also choose to do if you want, do whatever you want, you're an adult, is I look at the context and then I look at, okay, how tight are we? What is my sort of expected probability here? What's my reward to risk? Does it make sense mathematically? And by the way, when I think about that, it's not like I'm thinking, okay, this has a 62.45% chance. That's not how it works in real time, big dog. You get better with this with time, but you end up, it's always an educated estimate whether or not you have edge on the trade over a mid and long-term sample size. Okay, so, and you get better with that at time. So in the beginning, maybe only 50% of your trades you actually have edge on, and you're still a losing trader because you're giving it all back on the other half of the trades. With time, you want to get that closer to like 90 to 95% of the time. You know, when you look back at it, you're like, okay, I would take that trade again. I know that supports my edge. And maybe 5 or 10% of the time you look back on it, you're like, I probably wouldn't take that trade again. That's okay. You just want to get that percentage as high as possible that the trades you're taking you can stand by in hindsight. Even as you're already profitable, you look back on it, you're like, yeah, that supports what got me here. Okay, so I would never say that, oh, that trade doesn't make sense to take because it has an 11-point stop loss. That doesn't make any sense compared to what I just said, right? When you look at it through that lens. What I might say is, okay, if the ATR is 70, this trade has a 7-point stop loss. That's a very low probability. And in prop accounts especially, I'm not willing to take on the highly probable long losing streaks that math produces. Big Trev, my man. The rest of you guys, everybody fell asleep. I'm telling you, I think this is too deep for a YouTube live stream. Either everyone's taking notes or no one knows what the hell I'm talking about, but I'm sorry, man, this is what it is. To me, this makes all the sense in the world. I've also been doing this a while, so it's hard for me to grasp if you guys are following or if this is highly confusing. And you know what? Even if it's highly confusing, that's fine with me. I'd rather throw the book at you and yank you up then lead you down this weird dopamine path that just plagues the internet, unfortunately. In general, no one in particular, but in general, it plagues the internet of, yeah, risk 1 to make 100. Come on, man. Come on, man. With a 77% win rate. It's like, okay, great. You'll get that set up one time every 15 years. The frequency issue, right? Richard, Manuel, News Edge, Mister. These are my people. We love it. All right, we got 49 onward going sideways, 70 seconds out. ATR now 2021. This is a really tough area. This is a tough area, man. You go sideways for, well, it's been 20 minutes now, 49 onward. Okay, ATR is dipping below 20. That's not great. Not great. But I'll tell you what, man, gotta keep our head up. At least it's not 6. Okay, we're halfway through bar 53, still going sideways here. Since bar 49, here in the low end of this big range, it starts looking more and more like that soft bear channel. I'm curious to see if the bears can take us lower, finally break us out of here. It's been 23 minutes of battle in here at the low. Not the low of day, of course, the low of this sideways range. Okay, we've got about 20 points of width here in this single bar sideways trading range. It's pretty tight. That's pretty tight. So I'm hanging out here, waiting for a better opportunity. Okay, halfway through 54 here. Oh, goodness. Goodness, ATR sitting 19 and a half. Not as bad as 4th of July 2 years ago. Man, we had fun. 2 years ago, 4th of July, ATR, a legendary day, by the way, here on the channel. ATR was, I think, maybe about 4. And we still made money. Not a lot you can do when the ATR is 4, but we did what we could. ATR currently sitting at 18. Okay, we got the Bears taking us downside here, bar 55. Okay, so we got big bar 55. Now there is a lot of risk of sideways range here. Which makes this a relatively low quality setup. But I'm cool with it if I can get a reasonable close here. You gotta understand, I mean, the size of this bar is like less than 30 points. What a beautiful placement, by the way. Can you believe it? So now it's up to the bears. If they want it, sure, I'll participate for what will likely be a trade that will take a bit of time. If they don't want it, then my stop limit sell also did its job of not filling me when the bears aren't into it, which you can see they're running away. That's already 25 seconds. I gotta pull it. No fill, no trade. We got a bunch of baby bears at the wheel here today. ATR sitting 18.5. Question, is your rule 20 seconds to fill? And if not, you pull the trade? It's not quite that simple. I do it based on grade. Typically anywhere between 15 and 30 seconds on a 5-minute chart. The lower the grade of the setup, the less time I'll typically give it. That's for a stop limit entry, which is typically done for continuation trades. Well, basically always done for continuation trades. Yeah, we got 60 seconds here on bar 56. Okay, we got a new bar. Bar 57. Come on, 57, let's save the day. ATR down to 17, oh man. Romeo says, bar 57 is not saving the day, good sir. Romeo, you better watch your mouth, big dog. 57 is the golden child. Now, if somebody could hand Trump his iPhone, I think the rest of us would appreciate it. Get him saying something crazy. Okay, so, I'm looking at this. We had this big sideways range that is clearly now attempting to turn into more of a very soft bear channel, right? Then you have this single bar sideways range. So what I am going to do is short this, and I'm going to use the wick high of 48. There we go. See if these bears got anything here. James, how we doing? Question. How does ATR work? I know it's the average range of a 5-minute bar, but does ATR track the range of the past 10 bars, 15 bars, or the whole day's average? Yeah, you can set it. I set mine to a value of 10, which means any chart that I'm on, my ATR will average the last 10 bars on that chart together, whether it's a 2-minute chart, a 5-minute chart, a 15-minute chart. It's always 10 bars, which obviously is different amounts of time depending what chart you're on. So that's how ATR works. But you can set it to whatever you'd like. All right, bears. ATR sitting just below 20. Oh, you bears! Holy shit, ATR is 17. 17. Richard says got a $900 first ever payout coming tomorrow. Done for the day. My man. That's right, Richard. Code Big Dog. BIG. Now, if these bears could grow up nice and BIG and take us down about, what do you guys think? In this volatility environment, I'm not going to be greedy. So maybe 250 points on a single 5-minute bar. I think that sounds about right. All right, so far here I've been 14 points in the money. That's not enough. It's not enough. Chat says, I recommend watching the NQ book map. If you're not already doing so, clearly shows a thick wall around 29,200. That's why I didn't short it. Well, all the best to you. I hope that works out for you. Okay, 242 out here on Big Bar 59. Chat, may I ask what trading platform you use? This is NinjaTrader that you're looking at. Okay, flat. Alright, I need a refill. Give me 2 minutes. Don't you go anywhere, big dog. Which button is it again? There it is. All right. Welcome back. Okay. Oh, Jesus. We got bar 62. After 61, just a monstrous bar. What was the range on 61? Less than 30 points, but it looks huge in today's environment. So the question now really becomes, zoom out a little more. The question really becomes, I mean, realistically, it's these are kind of like big, broad strokes now. Or do we end up seeing this fail and we go back into a soft bear channel? Realistically, the best we can do right now, I would say, is about this. Obviously, as volatility falls deeper and deeper into the afternoon, as it currently is, ATR now 17, you probably cut this guy at about half. Have it be just as valid until it's not. So keep an eye out here. Now again, as far as your sizing goes, guys, I don't encourage people to size up in range markets that are low volatility. I know the initial assessment is like, well, if my average trade is 15 points of risk, when typically it's more like 40, I should probably size way the hell up, right? To make it worth my time. Well, the edge that you're going to be able to find is going to be smaller. So I allow the market to shrink my size for me with the average points per, I should say average points at risk per trade being less in a lower volatility market environment, especially when it's a range environment. You have a better argument for sizing up if you know your edge well and it's a lower volatility trend market. But, you know, a low volatility range market is kind of the worst combination of the four, right? Low volatility, range. And then in the middle, you know, you have low volatility and trend. It's a little bit better. High volatility and range. Somewhere in the middle there as well. And then, you know, best market, at least in my opinion, is going to be a high volatility trend market. So when you get really low volatility and it's a range market, for most traders, regardless of what you trade, it does not have to be RAM, by the way, that's kind of going to be the worst combination of the four. So again, I don't encourage you to size up when that is the case, just to make the dollar amounts look the same. Get ready just in case. A lot of hesitation out of these bulls, man. It's ugly. It's ugly. Big wick up top here, bar 62. All right, let's watch 63, see what it's got. We got 2 minutes. 2 minutes here on 63. Okay, 13 seconds. Stop when buy goes out. I'm ready. Ooh, did you see that? You gotta be careful of that rollover. When a bigger bar falls off the end of your monitor, you gotta be careful with it. You'll end up placing it in a spot that you definitely don't want to place it. But I did all right there. All right, sitting long. There you go, bulls. A little better volatility going here. ATR currently sitting at 17. Could pop to 18, watching. Come on, you bulls! Man, story of this market lately. They get you within 2 points. And can't finish. Okay, ATR sitting at 18. Alright, we got a new bar. Bar 65 opening up. Chat, can you be more clear when you're about to open a trade? I missed this one. Well, chat, this is not a signal service. This is a free live stream on YouTube. To hopefully educate and maybe entertain sometimes. Which is a little tougher to do when the ATR is 17. Okay, down to 17 on the ATR rather than 18. Let's see if these bulls can take one more run at it. They had me so close. Okay. ATR 17. The bulls so far had me, I think, better than... better than 15 points in the money. Target full ATR. Damn close. Come on, bulls. There you go. We got 60 seconds left here. On Big Bar 65. And if you're just joining us here, this trade so far had me a couple of points from take profit. No cigar yet. See if these bulls can give me one more push. By the way, guys, this kind of thing happening to you, it's going to happen no matter how much you adjust and start taking profits early. It will continue to happen to you. You'll have trades that get within 2 ticks of take profit and turn around. And it's really easy to get really frustrated and say, well, I'm just going to take it 2 points early next time. I'm telling you, it's not the correct move. Long term, your edge will just get worse and worse and worse and worse. And the very thing you were trying to solve, which was your short-term frustration, will just lead to long-term frustration. I'll take short-term frustration over long-term frustration. Because at least with short-term frustration, you can fall back on your past performance. But I will say that doesn't change the fact that it's like, man, story of the market lately. Take you within 2 points, and then can't finish the job. It's a symptom of low volatility, by the way. It's also a bit of a fallacy. It feels that way. It's not really that way, at least with a big enough sample size. But it can certainly feel that way. Okay, we got a new bar here, 67. Open it up. By the way, ATR down to 16.5. And you know volatility's low when a bar opens, pumps about 11 points, and it feels like a real big move. You know the volatility's getting low, man. ATR still holding on to the teens. Well, Bear's trying to take you back here and see if they can take out the wick low of 63. The original signal bar. Yet if you're just joining us here late, so far the Bulls had me a little better than 15 points in the money. Not enough. Not enough, but damn close.
Thank you.
Okay, you got 67. Rolling over into new bar 68. The average true range has fallen here. We're down below 16. It's 15.9 on the ATR. All right, Bears, what you got? See if they can take out the wick low of 63, my original entry. ATR sitting 16.75. We got big bar 69 opening up. Okay, flat. Bulls. What was it? Maybe 6 ticks away from target. They can't get the job done. All right, let's watch 69. Man, this ATR is so low. Volatility is dead. See what these bears got here. Okay, I am watching Big 69. Okay, 7 seconds out. Copier engaged. Oh, bulls. See if the Bears want it. See if the Bears want it. Stop limit sell goes out. Give this about 25 seconds. Low volatility. ATR still holding on to the teens, by the way, sitting at 15. Nothing. Gotta pull it. They don't want it. I don't want them. Okay, 253 out here from the close-up of 70. It's getting kind of late in the day, by the way, 2:17. 3:17 Eastern. "58 seconds. Let's see how 70 closes up. Well, I better be ready just in case. Let's see if the Bears want to suck it down a hair. All right, I'll give that 20 seconds, see if they want to take it. And they will! Now, of course, counter risk on this trade is if volatility, I mean, we're already at 15.16 on the ATR. If volatility dries up even more than normal in the current market environment and ATR starts falling to like 9, which I gotta tell you, we have not seen very much during the New York session. It's been a while. Then we would likely revert and just hang out in the middle of this big trading range into the close, which is not that far out, 37 minutes. All right, new bar, 72. Open it up. We only got 78 on the whole New York session. So we're coming down to the wire here. Oh yeah, I gotta move the... Well, I can't do it while I'm live. The contract size is the same. I don't know why it's off center now. Oh my goodness. Okay, so in 35 seconds, we're going to be rolling over. And it happens to be 3:30 Eastern. Okay, now, I don't really care because this is not large risk for me. But you can sometimes get algorithmic movement at 3:30. Especially when volatility is low. So let's see what we get, man. 10 seconds out. Not much, huh? Sometimes you get it, sometimes you don't. Not too much today. All right, baby, come on now, you bears. I want to see us grow some claws. I want to see these bears put on about 400 pounds in 2 months. Grow up big and strong and give me 700 points on one 5-minute bar. That seems about right. Holy shit, this is slow, man. ATR officially below 15 for the first time today. Goodness. All right, Bulls. Wick high of 70. What you got? That's it. That's it, man. I tell you what. Volatility. We need volatility to come back. It turns out, so when I first got on stream, we were looking at this, right? We faded out. Realistically, we turned it into this, which is effectively this. Contextually speaking, okay? But volatility is so low in comparison to the width of that. That's about 100 points wide, maybe. Well, maybe a little less, depending how you look at it. That, you know, it's for me, I can't trade based off a soft bear channel that's, you know, 7x the ATR. It's just too difficult to make entries, or I should say to take entries that make logical sense and still be able to manage risk in a way that makes sense. Realistically, you've only had two tests to the upside there, so really you couldn't have even looked at it this way until bar 67, and by that time we were already looking at it this way. By the way, if you're in a trade right now, 2.5 minutes, and then you've got that 340 Eastern Time algorithm, the 350 Eastern Time algorithm's baby brother, you typically get a little bit of volatility at 330, and then 340, and then the big dog most days is 350, at least out of the three. Doesn't mean you're going to get a ton of volatility at 350. Of course, it tends to mirror the already existing volatility conditions based on how many points you can kind of expect volatility-wise when 350 hits. So, yeah, you know, again, you know, the benefit of letting the market sort of determine your size. Again, you know, you can size yourself appropriately with two different methods, right? You can change the contract size, or you can let the market volatility do it for you, or a combination of both. The benefit of trading in a range market that is low volatility, again, kind of that bottom of the barrel combination. It's low volatility, it's not moving very much, and it's in its sideways trading range. That's sort of the worst combination. That happens to be the combination that we're currently in. It never lasts forever. We'll be out of it here soon enough. But that's the reality of the market that we're currently in, okay? So the benefit of letting the market determine your dollar amount risk is if you keep your size the same, your average points at risk per trade goes way down, okay? So the dollars, think of it this way, that you're betting per trade are now less, which is congruent with your edge being smaller. So think of like a poker player. I think everyone kind of understands this, right? If someone plays poker professionally, they're not betting the same amount of money if they have a shit hand versus if they have the greatest hand in the greatest setup, I guess. Not really a poker guy, of their career, but I understand the math behind it, okay? They're gonna bet way more when they have a good hand. The same way that I'm going to let my dollar amount risk per trade creep way up if we're in a high volatility trend market. It'll often be in the 5-figure range per trade. Whereas, in a low volatility trend market, it's going to come way down. So, anyway, just sort of the math behind it. I think ideally we see volatility return a bit. It might be a tall order to look for the end of this month here. We're basically already there. Early September would be great. I really don't think the market's going to remain as slow as it has been until late October. Like a lot of people are I think, kind of just pulling out of nowhere. As you curl into the fall time season, if you got the summer slowdown at all, which by the way, last year, 2025, the summer slowdown was awful. It was really slow all summer. This year, June was great. July was great. Even the beginning of this month, August, if you recall, was really, really good. I'd say like the back 2/3 so far of August, it was very abrupt and it slowed a lot. I think once we roll through September, it's going to be really a question of when in September. I'm going to hope for the best and hope it's early September. We'll see ATRs, I'll say midday, back in the 30s or 40s as kind of a regular occurrence. And that makes our job quite a bit, I hesitate to use the word easier. But as you know, when ATR on a 5-minute NQ starts getting below 20, our job gets quite a bit tougher. When it gets below 10, which thank goodness we haven't seen, it gets a lot tougher. At that point, it's probably time to walk away if you have an ATR on a 5-minute NQ below 10 during the New York session. Currently, again, 16, bottom right of the chart on your screen. So, above 30 is great. Above 40, even better, especially if we're talking midday. And I think we're going to get back to that here relatively soon. Typically, at least in 10 years, I have not seen really a market that did this for 2 years straight. And I don't, knock on wood, I don't know if we're going to see that in our careers, just because the way that this market, the interest is increasing exponentially. If you look back at how markets operated, like you look at Black Monday, obviously the price was a lot lower, so the points aren't really 1-to-1. But just the way that they operated, they were so much wider. Meaning, the bid-ask spread was so much wider. And you would think that with enough volume, that would create a laddering effect where things move so much more quickly. And that did happen on Black Monday. But on your typical average day, not so much. That's why the people who really made a killing in the 80s, for example, were the guys on the floor basically acting as market makers, right? Because I don't know if you guys understand this, but in Chicago in the 80s, when they say guys were trading on the floor, you had two different types. Everyone wasn't really just trading. You had people who were basically speculating, and then you had the people who you hear from who were more so acting as market makers, and they were taking on risk onto their book. And a lot of times, they didn't even know what they had. They would have someone next to them, if they were serious, who would do all the calculations and tell them. Because basically, it was a different game than what we're doing today. It was a different way to have a career. They made money off the spread. So if a speculator walked up to them and said, hey, I wanna sell X at X, their job, the market makers, or the traders acting as market makers, was to say, okay, and then do that for them. And when you do that enough times, quickly enough during the day, you quickly start to lose track of what your actual net position is. Your job was to be fast and offer liquidity to anybody who wanted it and take the other side and then make money off the spread. Okay, that's totally different from our job here today, but that's what it was back then. So that being the case, again, that's why, anyone making money off the spread today is like Citadel. It's a different game. You don't really have humans doing that these days. So our job as traders has sort of the definition has shifted a bit. But today, since you have so much more interest, and even though the bid-ask spread has tightened because there's so much more volume, it has not had the effect that you might see on like Bank of America stock, where the bid-ask is so tight that it kind of suctions it in one place and it takes a lot of volume to move it one way or the other. You don't really see that today in NQ. The bid-ask spread is so, liquid, I should say. It's tight enough where you can actually put on reasonable size without too much slippage, and that'll only get better, but we haven't lost the volatility. And some people, I get this question every once in a while, someone who kind of understands the game, they say, well, as volume starts to increase more and more, and the bid-ask spread gets even tighter, is it going to get tougher and tougher to make money because the market's not going to move as much because you have more and more volume on either side? I don't personally believe so. I think the interest, like Bank of America has an interest problem. You don't really have too many people making plays, big plays on Bank of America, causing a lot of volatility and eating through that liquidity, right? It kind of just sits. Something like NQ or the Nasdaq in general, being the collection that it is, I don't think we're going to see that problem, even with increased volume. I think it'll only make it easier to take larger and larger positions, which for everybody here, if you're not already thinking this way, you should be. That's going to be really important for all of us down the line, because your goal should be eventually to trade. I mean, we'll see where the prop industry heads, right? But I think the goal for everyone here should be to do all of it as big as, including personal accounts, as big as humanly possible long term. So the more we can take large positions with less side effects of big size, which is slippage, and it's like slow. Now rather than driving a speedboat, you're driving a cargo ship. The bigger that port gets, right, the more size you have on the bid-ask spread at any given moment, even in a slow afternoon like this, the better, because it gives us more liquidity without really, like we just talked about, sacrificing that volatility, which I don't think we're going to see. I think we're going to see volatility only continue to increase big picture over the next few decades in something like NQ, which is good, which is, again, I think a big reason why it's important, I think, to bet on futures as kind of a primary trading instrument, because it's so well designed around such great markets that I think it's hard to beat. Again, these were designed, futures in general, to be hedging instruments and active trading instruments. You cannot say the same for stocks. You cannot say the same for options. Forex has its own 1,000,001 issues. Crypto, don't get me started. As far as active trading it, the fees, the spreads are horrendous. So futures are kind of like the spot. If you're an active trader looking to get, a lot of experience for the next few decades, and you want the ability to scale and take really, really, really big size. Really big size. I think this is the spot, at least for intraday. Okay, guys, so we're coming into 250, minute 18 out. I'll tell you what, man, as you guys trickle out, I will see you tomorrow. It's coming. Volatility's coming back. Hang in there, man. Keep your head high. I'll see you guys soon.